For decades, many Asian countries have racked up huge trade surpluses with the United States, and in turn, they've been amassing vast reserves of US dollars. These reserves aren't just sitting in vaults, and so they have been invested in American assets like treasury bonds and real estate and equities, of course. Economists Stephen Jan and Joanna Freire believe that the dollar pileup may now exceed $2.5 trillion, largely in the hands of Asian exporters, think US-China trade war, and institutional investors. What's more, many of these positions are what's called naked longs, which means unhedged bets on the strength of the US dollar. That means that if the US dollar weakens, there is really nothing protecting these bets from losses. And that vulnerability, that exposure to risk, might now be triggering a dramatic rethink and adjustment in global finance. Well, part of it comes down to politics, of course, and policy. Asian governments and companies are effectively being forced to reassess their strategies and their positions. And now they're thinking, well, if there's this much risk involved, they're thinking to sell, if not $2.5 trillion right away, they're going to start selling small portions of it. We're already seeing signs of that change. Bloomberg's dollar index has actually dropped around 9% since January of this year, and nearly all Asian currencies, including the Chinese yuan, the Taiwanese dollar, and the Malaysian currency, have strengthened against the US dollar in the past month. Some analysts actually think Asian policymakers are preparing to let their currencies rise as part of broader trade negotiations with the United States. And there's another critical piece to this puzzle that I would like to mention. It is repatriation. Economist Stephen Jan suggested that around $1 trillion could actually return to China as Chinese companies begin unwinding their dollar-denominated investments, especially if the Federal Reserve continues cutting interest rates. And so lower US yields mean lower incentives to keep capital effectively parked in dollar assets. That kind of capital flight isn't just a ripple, it is a surge. As investors pull money back home, they're actually going to sell US dollar assets, putting additional downward pressure on the currency. If this $2.5 trillion avalanche begins to slide, the global impact could be profound. A weaker dollar would actually make imports more expensive for Americans, potentially driving up inflation at a time when price stability is already very, very fragile. US bonds could sell off as well, and central banks might be forced to step in to stabilize currencies and interest rates. If the dollar loses appeal, investors might pivot more toward emerging market currencies, toward even digital assets like Bitcoin, for example. So what should we be watching? First of all, keep an eye on trade policy. Any new escalations in US-Asia tensions could escalate the selling. That could incentivize Asian investors to actually go ahead and de-risk, which they have already started doing. The second thing to be on the lookout for is try to monitor Federal Reserve decisions, especially around rate cuts. And finally, track currency movements in Asia. If we start seeing more rapid gains in currencies like the Taiwan dollar or the Chinese yuan, that could actually serve as a signal of a broader unwind of dollar positions. If Asian economies begin shifting even a fraction of that $2.5 trillion back home, it could fundamentally reshape how money moves around the globe and what other investors who are watching this do potentially once they see this unwinding begin.